and welcome to Financial Intelligence. In this video, I want to talk about the US tax system. The US has long had two tax systems, one for people who work for a living and another for the wealthy. The vast majority of Americans work for a living and earn a paycheck. Some money is withheld from their paycheck every pay cycle, and they end up paying at rates that vary from 10% to 40% based on the income level. The wealthy, on the other hand, do not receive paychecks. Most of their wealth is in the form of stock portfolios and real estate investments. There are many tax loopholes that allow the rich to earn money that is excluded from taxation. For instance, they can just use financial derivatives or loans to get money to live on, and so they don't need to have any taxable income. In this video, I'm going to cover 3 common strategies used by the ultra wealthy to minimize their tax exposure. Note that there are many more strategies, but I have decided to cover the ones that are widely used. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Strategy number 1, incorporating. One way to save on taxes is creating a structure such as a limited liability company, or LLC for short, to manage multiple investments. It could include portfolio assets, real estate, or a business. The IRS usually treats an LLC like a sole proprietorship or a partnership, depending on the number of members in the LLC. However, a corporation or LLC which elects to be taxed as a corporation can be a tax shelter because the tax on its income is limited to 21%. This rate is lower than the top 3 individual income tax rates, ranging from 32% to 37%, which would otherwise apply to LLC owners at various income levels. Business owners who regularly need to keep a substantial amount of profits in their LLC, called retained earnings, benefit from electing corporate taxation. Any LLC can choose to be treated like a corporation for tax purposes by filing IRS Form 8832. Another important benefit of incorporating is the tax code provisions that govern deductions and yield huge benefits. The more tax deductions a business can legitimately take, the lower its taxable profit will be. LLCs can deduct expenses such as purchasing a car, expenses of going into business, books / legal / professional fees, insurance, travel, interest, and equipment. Strategy number 2, avoiding capital gain tax. In the US, most people make their money from a regular job. They get a paycheck and pay income taxes. But the richest Americans, the top 1%, make most of their money from things like investments in real estate or the stock market. Those investments are taxed as capital gains. The capital gains tax is imposed on the profit from an investment that is incurred when the investment is sold. When stock shares or any other taxable assets are sold, the capital gains or profits are referred to as having been realized. The tax does not apply to unsold investments or unrealized capital gains, so stock shares will not incur taxes until they are sold, no matter how long the shares are held or how much they increase in value. This means that simple buy and hold investors need to pay no tax. This is actually proven to be the winning strategy both in the stock market and in real estate. Since most wealthy individuals have longer investing horizons, they let the value of their investments grow without selling their holdings on a regular basis. Therefore, they can avoid having to pay capital gain taxes. Strategy number 3, borrowing money. One of the key strategies employed by the ultra wealthy to keep their tax bills low is borrowing money. Many Americans borrow money only when they have to make large purchases like buying a car or a house, as interest can quickly add up, especially if they're not able to pay back the loan right away. Borrowing money allows the ultra wealthy to earn minuscule salaries, avoiding the 37% federal tax on top incomes, as well as avoid selling stock to free up cash, bypassing the 20% top capital gains tax rate. Since loans aren't considered taxable income, the wealthy need only pay back the principal and interest rather than the higher taxes that would accompany multi-million-dollar incomes and investments. The ultra wealthy have large stock portfolios that pay a huge amount of dividends, which are considered as regular income by the IRS. On the other hand, interest payments are tax deductible. Therefore, the ultra wealthy can use these interest payments to write off some of the amount they receive as dividends and thereby reduce their total taxable income. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.